welcome to this explainer. Look, if you're a CFA Level 1 candidate, you already know that financial statement analysis can feel like this massive, impossible brick wall standing right between you and your certification. But today, we're going to break that wall down. Consider this your ultimate step-by-step concept analysis. We are going to conquer inventory valuation methods together and turn all that exam anxiety into total confidence.
Have you ever found yourself just sitting in a quiet library, staring at your textbook, with this exact thought running on an endless loop in your head? Well, you're definitely not alone. It is incredibly common to look at FIFO, LIFO, and weighted average and feel like they just blur together into one giant, intimidating mess of numbers. It's enough to make anyone's confidence totally plummet. But we're going to approach this a bit differently today. We're drawing on a brilliant study strategy that turns that exact moment of library panic into complete and utter mastery.
So here is our roadmap for the tutorial. Step 1, we master the core methods. Step 2, we spot the exam traps. Step 3, smart AI practice. And Step 4, we wrap up with some final exam tips. Let's jump right in.
All right, Step 1, mastering the core methods. We really have to build a solid foundation first.
Before we can even think about valuing anything, we kind of need to know what we're actually looking at, right? At its most basic level, inventory is simply the stock of goods or materials kept by a company specifically for the purpose of sale. It's the physical stuff just sitting in a warehouse waiting for a buyer. But how a company assigns a specific cost to that stuff when it finally does sell, well, that is exactly where our three major valuation methods come into play: FIFO, LIFO, and the weighted average cost method.
Okay, let's bring this to life with a practical case study to really anchor the math. Imagine a company called Freshmart Private Limited. Over the course of January, they buy inventory in 3 distinct batches, and they're doing this while prices are rising due to inflation. Batch 1 is 100 units at 10 rupees each, so that costs 1,000. Batch 2 is 100 units at 12 rupees, costing 1,200, and Batch 3 is 100 units at 14 rupees, which costs 1,400. So getting straight to the bottom line, Freshmart has 300 total units of inventory sitting in their warehouse, and it costs them exactly 3,600 rupees.
Now here is where the game actually gets interesting. Freshmart makes a sale. A customer comes in and buys 200 units. The absolutely crucial question you have to answer on exam day is this: what is the cost of goods sold, or COGS, for those 200 units, and what is the value of the 100 units left behind in ending inventory? And the kicker is, the answer changes entirely depending on which accounting rule you decide to apply.
Let's kick things off with FIFO. First in, first out. Honestly, this is probably the most intuitive one. FIFO assumes that the absolute oldest stock is the first to be sold. So to fulfill that 200-unit order, Freshmart grabs the 100 units from the very first batch at 10 rupees and then the next 100 units from the second batch at 12 rupees. You add those up and your total cost of goods sold is 2,200 rupees. And because we sold the oldest, cheapest stuff first, what is left sitting in the warehouse? The newest, most expensive stuff. Your ending inventory consists of those 100 units from batch 3 at 14 rupees, which values your ending inventory at 1,400.
Now let's flip that around and look at LIFO. Last in, first out. This paints a completely different financial picture. This method assumes the newest stock, the very last batch purchased, is the first to head out the door. So to get our 200 units this time, we start at the bottom. We take the 100 units from batch 3 of 14 rupees and 100 units from batch 2 at 12 rupees. Suddenly, our total COGS jumps way up to 2,600 rupees. And what's left behind gathering dust in the warehouse? The very first, cheapest batch. Your ending inventory drops to just 1,000 rupees.
Then you have the third option, which is the weighted average cost method. And this one kind of just throws its hands up and ignores the order of the batches entirely. You simply take the total cost of all your inventory, which was 3,600 rupees, and divide it by the total number of units, which was 300. That gives you a nice, clean average cost of exactly 12 rupees per unit. From there, the math is incredibly simple. Your COGS is just your 200 units sold multiplied by 12, which is 2,400. And your ending inventory is your remaining 100 units multiplied by 12, giving you 1,200.
If you line these up side by side, the difference in the cost of goods sold is literally staring right at you like a staircase. And this perfectly illustrates the exact dynamic examiners want you to understand. FIFO gives you the lowest expense at 2,200. LIFO gives you the highest expense at 2,600. And weighted average sits perfectly right in the middle. Remember, we set up a scenario where prices were rising, inflation. In an inflationary environment, your choice of accounting method fundamentally, massively alters the expenses you report on your income statement.
Which brings us to Step 2, spotting exam traps. The math is fine, but now let's talk about how the test makers are absolutely going to try and trick you.
So here is the absolute core of the trap, understanding the mechanics of inflation. Examiners love, and I mean love, inflation-based scenarios. Under FIFO during inflation, you're selling your older, cheaper inventory. That means lower COGS. Lower expenses immediately translate to higher net income, which makes the company look highly profitable. But under LIFO, you're selling your newest, most expensive inventory. That creates a higher COGS, which totally crushes your profit margins, resulting in a lower net income. Seriously, if you can instantly visualize this relationship, you will breeze through half the conceptual questions on the exam.
Oh, and here's a crazy little fact that doubles as a golden exam trap. In most of the world, LIFO is practically illegal. Under International Financial Reporting Standards, or IFRS, the LIFO method is strictly not allowed. Period. End of story. However, under US GAAP rules, LIFO is allowed. This binary comparison is a highly probable multiple-choice question. Always check which accounting standard the question is asking about before you even start calculating.
All right, step 3, smart AI practice. Let's talk about studying smarter so you don't completely burn out.
A real game changer right now for modern study strategies is leveraging AI tools like Microsoft Copilot. You can literally use it in 4 very specific ways. First, for instant concept explanations. If you get stuck, just ask it to explain a concept using simple examples. Second, ask it to generate CFA-style multiple-choice questions on inventory methods, giving you endless mock practice. Third, use it for rapid formula revision by asking it to spit out summary tables. And fourth, have it map out complex financial statement impacts, like figuring out exactly how LIFO affects gross profit or taxes. But, and this is a massive caveat, AI is a helper, not a substitute. You still have to develop the final underlying intuition yourself.
Finally, step 4, final exam tips. Let's pull this whole thing together into a game plan you can actually use. If you're going to take notes or mentally bookmark anything today, make it this definitive cheat sheet. Number 1, understand the logic of the flow. Please don't just memorize formulas. Number 2, actively practice inflation scenarios, because I promise you that is what's going to be on the test. Number 3, always connect COGS, ending inventory, and net income holistically. If you pull one lever, the others shift. Number 4, lock in that IFRS versus US GAAP rule. Number 5, combine AI assistance with your own hard work. And lastly, do mock questions every single day. For this chapter, practice absolutely beats pure theory.
Conquering CFA Level 1 isn't just about absorbing a massive syllabus. It really is a test of your discipline, your patience, and your strategy. As we've seen today, a concept is literally never too difficult. When you break it down structurally and find the right guide, that very concept transforms from your biggest fear right into your greatest strength. Inventory methods are no longer a trap for you, they are guaranteed points on exam day. But I want to leave you with one final thought to ponder. We just solved for an economy with rising inflation. But what happens to your income statement if the market crashes and prices actually start falling? How does deflation flip the whole LIFO and FIFO script? Think about it, keep practicing, and we will see you in the next explainer.